Hello, welcome to Capital Sensei. Today, we're going to dive deep into one of the most practical and empowering investment books ever written, Beating the Street by the legendary Peter Lynch. We'll explore his incredible track record, break down his core philosophy that you, the average person, actually have an advantage over Wall Street professionals, and walk through his step-by-step process for finding, researching, and managing winning stocks. This is all about using your everyday knowledge to achieve extraordinary returns. And as always, we try our best to answer your questions in the comments section. So, if anything we discuss today sparks a question, or if you have your own stories about investing in companies you know, please share them below. Your experiences and doubts are what make this community a fantastic place to learn and grow together. All right, let's talk about Peter Lynch. If you're new to investing, you might not know the name, but in the world of finance, he's a rock star. From 1977 to 1990, Lynch ran the Fidelity Magellan Fund. To say he did well is a massive understatement. He took a relatively small fund of about $18 million and grew it into a $14 billion behemoth. That's not a typo. $14 billion over those 13 years. He delivered an average annual return of 29.2%. Now, let's put that number into perspective. If you had invested $10,000 with him in 1977, by the time he retired in 1990, you would have had about $280,000. The broader market, the S&P 500, would have turned that same $10,000 into about $64,000. Lynch didn't just beat the market, he absolutely demolished it, and he did it consistently for over a decade. The natural question is, how? What was his secret? Was it some complex algorithm or a crystal ball? Not at all. And that's the beauty of his message. The central, earth-shattering idea of beating the street is what Lynch calls the amateur's advantage. He argues, very convincingly, that regular people like you and me have a built-in edge over the big-shot professionals on Wall Street. Now, that sounds completely backward, right? These are the folks with fancy degrees, access to incredible amounts of data, and their entire day is dedicated to analyzing stocks. How could a doctor, a teacher, or a plumber possibly compete? Well, think about the constraints those professionals face. A fund manager overseeing billions of dollars can't just buy a small, promising company. If they invest, say, $10 million, it's just a drop in the bucket for their fund. It won't move the needle. So they are forced to focus on the same large, well-known companies that every other fund manager is also looking at. There's not much of an edge to be found there. It's a crowded playground. Furthermore, professional managers are judged on their short-term performance. They have to report their results every quarter. If they have a bad 3 months, their clients might pull their money, and their boss might fire them. This pressure forces them to think short-term, to avoid taking risks that might pay off in the long run but look bad right now. They often end up buying what's popular and safe, which is rarely what's cheap and poised for massive growth. It's a herd mentality. And then, there's the concept Lynch famously coined, diversification. To reduce risk, funds are often forced to own hundreds, sometimes thousands of different stocks. The problem is, nobody can truly understand that many companies. What ends up happening is that their few great ideas get diluted by a vast ocean of mediocre ones. Their portfolio starts to look just like the overall market index, except their clients are paying high fees for that uninspired performance. Now, contrast that with you, the amateur investor. You have none of those restrictions. You can invest in a tiny, unheard-of company that has the potential to grow 100-fold. You don't have a boss demanding you show a profit by Friday. You can afford to be patient and wait 5 or even 10 years for your investment thesis to play out. You can concentrate your money on a few great ideas that you genuinely understand. You are nimble, you are patient, and you are free. That is your advantage. The first and most famous pillar of Lynch's philosophy is invest in what you know. This is so often misunderstood. It doesn't mean you should just buy stock in Apple because you like your iPhone, or in Starbucks because you drink their coffee every morning. That's a starting point, but it's not the strategy itself. What Lynch really means is to use your specific, professional, or hobbyist knowledge as a powerful lens to spot investment opportunities long before Wall Street does. Think about it. Are you a doctor? You're on the front lines. You see which new drugs are actually working. Which medical device company is making something revolutionary that saves time and money? And which hospital chains are being run efficiently? You have a real-world, ground-level view that a financial analyst reading reports in a New York skyscraper can never have. That's your edge. Maybe you work in retail. You see which brands are flying off the shelves and which ones are collecting dust. You notice when a new store opens and the parking lot is constantly packed, day after day. You hear the customer buzz. That's valuable on-the-ground intelligence. Lynch himself had one of his biggest wins with Hanes, the apparel company. His wife told him their legs pantyhose were a fantastic product, sold conveniently in supermarkets, and were flying off the shelves. He did his research, and the stock turned into a massive winner. His edge came from a simple observation in a grocery store. The key is that your profession or your deep-seated hobbies give you a unique circle of competence. You understand the industry jargon, the competitive landscape, and the customer dynamics in a way that an outsider simply cannot. This is where you can find those hidden gems. If a company's success shows up in the quarterly earnings report and gets Wall Street excited, it first shows up in the real world. Your job is to keep your eyes open in your own backyard. Of course, spotting a promising company in your daily life is just step one. This is where the amateurs who fail get it wrong. They stop there. Lynch is adamant that you must follow up that initial insight with some good, old-fashioned homework. He called this the 2-minute drill. Before you buy a single share, you should be able to explain to someone in 2 minutes or less exactly why you are investing in this company. What is the story? What is the catalyst for growth? If you can't articulate a simple, compelling story for why this company's earnings are going to be higher in the future, then you have no business owning it. The story could be anything. Maybe they're expanding into new regions. Maybe they have a new blockbuster product. Maybe they're aggressively cutting costs, which will boost their profit margins. Maybe they have a strong brand that allows them to raise prices. You need to know this story cold. After you understand the story, you have to check if the numbers back it up. Now, don't get intimidated. Lynch wasn't a fan of complex financial models. He believed in using a few simple common-sense metrics to get a picture of the company's health. One of his favorites was the price-to-earnings ratio, or PE ratio. Simply put, this tells you how much you're paying for $1 of the company's annual profit. A PE of 15 means you're paying $15 for every dollar of earnings. Lynch used the PE ratio as a quick gauge of value. He famously liked to compare a company's PE ratio to its earnings growth rate. This is known as the PEG ratio. If a company is growing its earnings by 20% a year, but its PE ratio is only 10, that's a very attractive situation. You're getting a lot of growth for a very reasonable price. On the other hand, if the growth rate is 10% and the PE is 40, you're likely paying way too much for that growth. It's a simple but powerful check on your enthusiasm. Another thing Lynch was obsessed with was debt. He hated it. A company with a ton of debt on its balance sheet is fragile. It's like a family living paycheck to paycheck with huge credit card bills and a massive mortgage. If something goes wrong, a recession hits, a competitor emerges, that debt can become a crushing weight and even push the company into bankruptcy. On the other hand, a company with lots of cash and very little debt is resilient. It's a fortress. It can survive tough times and even use its financial strength to buy out weaker rivals during a downturn. Lynch always looked for what he called a strong balance sheet. Before you invest, take a quick look. Does the company have more cash than debt? That's a fantastic sign. If it has a mountain of debt, you need to be very, very careful. To really master his process, Lynch created a brilliant framework for understanding what you own. He believed that not all stocks are created equal. You can't have the same expectations for a giant, old utility company as you do for a tiny, fast-growing tech startup. So, he sorted all stocks into 6 distinct categories. Knowing which category a stock belongs to tells you what to expect from it and what to watch out for. The first category is the slow growers. These are your large, aging companies that are growing only slightly faster than the overall economy, maybe 2 to 4% a year. Think of a big electric utility. Their main attraction isn't growth. It's their reliable and often generous dividend payments. You buy these for income, not for spectacular capital gains. They're like a big, sturdy old oak tree. They're not going to grow much taller, but they provide great shade and aren't likely to fall over in a storm. Next up are the stalwarts. These are large, well-known companies like Coca-Cola or Procter & Gamble. They're not growing at lightning speed anymore, but they're still growing faster than the slow growers, say in the 10 to 12% range. Lynch liked these because they're dependable. You're not going to get a 10-bagger, a stock that goes up 10 times, from a stalwart. But a 30 to 50% gain over a couple of years is a very reasonable goal. They offer good, solid protection during recessions because people will still buy Coke and Tide laundry detergent no matter what the economy is doing. Now for the exciting category, the fast growers. These are the small, aggressive, often young companies that are growing at a blistering pace of 20 to 30% per year or even more. This is where Lynch found his biggest winners, his 10-baggers, and even his 100-baggers. These companies have a great product or business model and a huge market to expand into. They are also, by far, the riskiest category. Fast growers are like saplings in a dense forest. Some will find the sunlight and grow into towering trees, but many will be crowded out and wither away. They carry the risk of failure, and their stock prices can be extremely volatile. But if you find the right one, the returns can be life-changing. Lynch's key advice here was to make sure they have a proven plan for growth and the financial strength to pull it off. Then we have the cyclicals. These are companies whose sales and profits rise and fall in a predictable or at least semi-predictable cycle that follows the broader economy. Think of airlines, automakers, steel companies, and chemical producers. When the economy is booming, people buy new cars and travel more, and these companies make a fortune. When a recession hits, their sales plummet, and they can lose a lot of money. The key to investing in cyclicals is timing. You have to buy them at the bottom of the cycle when business looks terrible and everyone is pessimistic. Then you sell them at the top of the cycle when business is fantastic and the outlook seems rosy. This is much harder than it sounds. Get the timing wrong, and you can lose more than half your money very quickly. Lynch warned that cyclicals are often mistaken for stalwarts by inexperienced investors, which can be a painful mistake. The fifth category is the turnarounds. These are companies that have been battered, bruised, and left for dead. They might have had a major screw-up, fallen on hard times, or just been mismanaged into the ground. Lynch loved a good turnaround story because the potential rewards are huge. If a company can successfully pull itself back from the brink of bankruptcy, its stock price can soar. A classic example would be a once great company that brings in a new, brilliant CEO who slashes costs, sells off bad divisions, and gets the company back to its profitable core. These are high-risk, high-reward plays. Lynch himself had great success with Chrysler, which was on the verge of disappearing before it was saved. He cautioned that for every successful turnaround, many more just continue to circle the drain. You need to see clear evidence that the ship is actually turning. Finally, we have the asset plays. These are companies where Lynch found a hidden value that the market was overlooking. The idea is simple. The company has some valuable asset. It could be cash, real estate, a patent portfolio, or even a valuable brand that is worth more than the entire company's stock market valuation. You're essentially buying $1's worth of assets for 50 cents. To find these, you have to dig into the company's financial statements, specifically the balance sheet. It's like being a treasure hunter. You're looking for value that isn't immediately obvious from the company's current earnings. For example, a struggling retailer might be losing money, but it might also own all of its store locations, and the real estate itself could be worth a fortune. Finding an asset play requires some sleuthing, but it can be a very safe and profitable way to invest. Once you've found some promising companies and categorized them, you need to think about how to put them together in a portfolio. Lynch had some very strong opinions here. He warned against the common Wall Street practice of owning a little bit of everything. As we mentioned, he called this diversification, the process of adding investments to your portfolio in a way that the benefits of diversification are lost and the portfolio becomes a worse version of a simple index fund. His point was that if you own 40 or 50 stocks, you can't possibly keep up with the stories of all of them. What's the point of finding one great fast grower that goes up tenfold if its impact on your overall portfolio is tiny because it's just one of 50 positions? It's much better, in his view, to own a smaller number of stocks that you understand deeply. So how many is the right number? Lynch thought that for most individuals, anywhere from 3 to 10 stocks is a perfectly reasonable number. The key isn't the number itself, but your ability to do that 2-minute drill for every single company you own. If you have the time and dedication to follow 15 or 20 companies, that's fine too. But never, ever buy a stock just for the sake of diversification if you don't have a compelling, well-researched reason to own it. Quality over quantity. Always. Knowing when to sell a stock is often much harder than knowing when to buy one. Our emotions get in the way. We get attached to our winners and can't bear to part with our losers. Lynch provided a clear, logical framework for selling that is tied directly to his 6 categories and the company's story. The fundamental rule is this: sell a stock when the story you originally bought it for has changed for the worse or has fully played out. For a slow grower, you might sell if they cut their dividend or if their business starts to seriously deteriorate. For a stalwart, you might sell after you've made that nice 30 to 50% gain, and the stock now seems fully valued, meaning its PE ratio has gotten too high relative to its growth prospects. It's time to rotate that money into a more promising opportunity. For a fast grower, you have to watch the story like a hawk. The minute you see signs that its incredible growth is starting to slow down, it's often time to sell. The stock price of a fast grower is propped up by high expectations. Once that growth decelerates, the stock can fall dramatically. This is why you must monitor them so closely. For a cyclical, you sell when the cycle is peaking. Business is booming, the company is making record profits, and everyone is optimistic. That's your signal to get out before the inevitable downturn begins. For a turnaround, you sell once the company has successfully turned around. The business is healthy again, and its stock price now reflects that reality. The easy money has been made. And for an asset play, you sell when the market finally recognizes the hidden asset and the stock price rises to reflect its true value. Or perhaps another company comes along and buys them out to get their hands on that asset. In either case, your investment thesis has played out, and it's time to cash in your chips. What you should never, ever do is sell a stock simply because its price went down. A price drop, in and of itself, tells you nothing. If the fundamental story of the company is still intact, if it's still a great business with great prospects, a price drop is a gift. It's an opportunity to buy more of a wonderful company at a cheaper price. Panic selling based on market noise is the single biggest destroyer of wealth for individual investors. This brings us to what might be the most important lesson in the entire book. Peter Lynch believed that in investing, the stomach is far more important than the brain. You can do all the research in the world, find the perfect company, and buy it at a great price. But if you don't have the emotional fortitude to hold on during tough times, you will fail. It's that simple. The stock market is volatile. It goes up and it goes down. There will be corrections, drops of 10% or more, and there will be crashes, which are drops of 20% or more. These are not a possibility. They are a certainty. They are a regular feature of the market. Since you started investing, you will live through several of them. The question is not if they will happen, but how you will react when they do. The average person's reaction is to panic. They see their life savings shrinking on the screen. They listen to the terrifying headlines on the news, and they sell everything, locking in their losses at the absolute worst possible moment. Lynch's advice is to do the exact opposite. A market crash is a fire sale. It's your favorite store announcing a 50% off sale on everything. When that happens, you should be a buyer, not a seller. This is when fortunes are made. It's when great companies become available at ridiculously cheap prices. To be able to do this, you have to ignore the noise. Lynch famously said that if you spend 13 minutes a year on economics, you've wasted 10 minutes. He had no interest in trying to predict the next recession, the direction of interest rates, or what the Federal Reserve was going to do next. He knew that was a fool's errand. Nobody can predict the macroeconomy consistently. It's just noise that distracts you from what really matters. What matters is the individual business you own. Is it still growing its earnings? Is its balance sheet still strong? Is its competitive position still intact? If the answers are yes, then you should ignore the apocalyptic headlines and hold on tight. Or better yet, buy more. Your success will be determined not by your ability to forecast the market, but by your ability to control your own emotions. And that requires patience. Investing is not a get-rich-quick scheme. It is, as Lynch demonstrated, a get-rich-slowly scheme. The big money is not made in the buying or the selling, but in the waiting. You need to give your great companies time to grow and compound their earnings. It takes years for a 10-bagger to unfold. One of the biggest mistakes investors make is what Lynch called pulling the flowers to water the weeds. This is when you have a portfolio with a few stocks that have gone up a lot, the flowers, and a few that have gone down, the weeds. The amateur investor's temptation is to sell the winners to lock in a profit and hold on to the losers, hoping they'll come back to even. This is exactly the wrong thing to do. You are selling your best-performing businesses and holding on to your worst. Lynch's advice is to do the opposite. Let your winners run, and periodically cut your losers if the story has deteriorated. Keep watering your flowers and pull the weeds. So to bring it all together, what is the ultimate message of beating the street? It's a message of profound empowerment. Peter Lynch dismantles the myth that investing is a dark art accessible only to the financial elite. He shows us that success is built on common sense, diligent research, and emotional discipline. It's about looking around in your own world, using your unique knowledge to spot opportunities that Wall Street has overlooked. It's about having the curiosity to then dig in and understand the story behind that company, to check the basic numbers to make sure it's healthy, and to categorize it so you know what kind of journey you're signing up for. And most of all, it's about having the guts, the stomach, to stick with your convictions when the market gets scary, trusting in your research, and giving your great companies the time they need to flourish. It's not easy, but it is simple. And it's a strategy that can allow any dedicated amateur to, in fact, beat the street.